Hey everyone, there has been a bloodbath in the technology stocks both in India and the US. In fact, after the crazy jump in share price during 2021 bull run, majority of tech stocks are down between 40 to 60% from their peak. So the tech stocks that were the favorite of investors have now suddenly become a well destroyer. And when you see your stocks falling 50 to 60%, it creates panic. In fact, this correction is similar to dot-com bust in year 2000 when majority of tech companies crashed between 50 to 90% and many companies went bankrupt. However, the silver lining in this tech crash is that fundamentally strong companies have always recovered from the worst scenario and created enormous wealth for their investors. Although we did not have many tech stocks in India during 2000 dot-com bubble, but I remember Amazon tanked 90% during that dot-com crash. In fact, during that dot-com bust in 2000, Infosys share price tanked nearly 78 to 80% from levels of 172 to levels of 38. And look at where Infosys is today. So the point I'm trying to make is that 2021 bull market resulted in a huge jump in tech stock share price and made them overvalued. However, this recent correction of 50 to 60% has brought down the valuation of tech stock to a very attractive levels. Hence, I want to discuss 5 fundamentally strong tech companies in India that have corrected between 40 to 50% from their peak and looking attractive at current levels. But before we proceed, I would request you to do your own research before investing your money. And this video is only for long-term investors looking to create wealth in the next 5, 10, 20 years. By the way, this video has a mega giveaway. I'll be gifting all of you free shares of world's most innovative company, Google. So do not miss this opportunity. Alright, let's get started. So first tech stock is from mobile ad business. It is Affle India. Affle India had its IPO in year 2019 and since then it had a dream run in stock market. The price jumped almost 800% over the next 2.5 years. However, since the beginning of this year, Affle India stock fell down almost 42% from its peak, but now it has recovered and currently trading at levels of 1000, still down 33% from its peak. If you look at the financials of Affle India, its revenues have consistently grown from 167 crore in FY18 to 1082 crore by FY22 at a superb CAGR of 60%. Whereas its profits have consistently grown from 28 crore in FY18 to 208 crore by FY22 at a brilliant CAGR of 65%. Now, how many companies do you know that are growing at more than 50% CAGR both in terms of revenue and profit? Very few companies. Affle is also highly profitable with 3-year average ROE of 34.1% and 3-year average ROCE of 32.8%. Company has debt to equity of 0.13, which is negligible. At current levels, it commands a P ratio of 63. Yes, the valuation is expensive, but considering the fact that Affle India is a growing company, it will command a premium. In fact, Affle India has a market cap of 13,000 crore, which makes it a small cap company. And as far as future growth is concerned, the future of mobile advertising is very, very bright. Today, every company is focusing on digital marketing, and that's where Affle India is very well positioned with its proprietary consumer intelligence platform. With the ever-growing usage of mobile phones, Affle India has a huge market to grow not only in India but globally. And Affle India is growing both organically and inorganically with acquisition. Hence, after the 33% correction, Affle India is looking very attractive at current valuation. Now, second tech stock is CDSL. CDSL share price jumped almost 700% from the COVID lows and then it has fallen 36% from its peak and currently available at levels of 1100. If you look at the financials, in last 5 years, its revenues have consistently grown from 146 crore in FY17 to 551 crore by FY22 at a CAGR of 30.4%. Whereas its profits have grown from 86 crore in FY17 to 311 crore at a CAGR of 29.3%. Company is highly profitable with 3-year average ROE of 24.9% and 3-year ROCE of 32.6%. It is completely debt-free with debt to equity of 0. At current levels, it commands a P ratio of 37. In fact, at its peak, it was commanding a P in the range of 50 to 60, but now it has corrected quite a lot. And as far as future is concerned, the demat industry in India is still in its nascent stage. CDSL has a market cap of somewhere around 11,500, which makes it a small cap company. And there are only 2 demat companies in India, CDSL and NSDL. That creates a huge entry barrier for competitors. and hence I expect CDSL to grow at a very good rate in the future. Yes, there could be some slowdown in growth as compared to FY21, where the profit jumped almost 100% due to huge demat account opening because of bull market. And now that we are in correction phase, there can be some impact on revenue and profit growth in the short term, but the long-term growth prospects are intact. Hence, after 36% correction, CDSL is looking very attractive. In fact, this correction is even brutal in the US market. For example, Netflix has corrected more than 70% from its peak. That's really brutal correction. And why did this happen? Because over the past 4-5 years, Netflix saw a huge growth in its business. In fact, Netflix saw a huge jump in its business during COVID lockdown. That resulted in sharp increase in Netflix share price. In fact, its share price jumped almost 600% in last 5 years. That resulted in crazy high valuation of Netflix. But after economy opened up, Netflix growth has slowed down and its valuation fell down crazily. In fact, after more than 70% correction, currently Netflix is available at a P ratio of around 16. Now Netflix is the leader in OTT platform all over the world. And I don't see Netflix shutting down its business in the near future. In fact, I see a good growth opportunity. Sure, it might not grow at the fast pace as it has grown in the past, but I still believe that after more than 70% correction, Netflix is worth investing. In fact, Amazon share price is corrected by 40% in last couple of months. Facebook has changed its name to Meta, that has seen a sharp correction of 50% in its share price and available at a P ratio of 14. Google parent company Alphabet has seen a correction of nearly 30%. So majority of top US tech stocks are down between 30 to 70% and now available at very attractive valuation. Just ask yourself, would you stop using Google? Would you stop watching Netflix? Would you stop using Instagram or Facebook or WhatsApp? Or would you not buy from Amazon? Well, these platforms are part of our life and we love these platforms. Hence, it makes sense to invest in these top US stocks. Yes, stock market might remain volatile for some time now, so it is always better to invest in a systematic manner. And let's not forget, investment in US stocks help in diversifying your portfolio. And of course, you also get the benefit of rupee depreciating against dollar. The question is, how to invest in US stock directly? Because most banks and brokers charges high account opening fee and high commission, and that is the reason why I use IND Money app to invest in US stocks. There is no commission on buying or selling stocks, no paperwork to open the account, no account opening or maintenance fee, and no flat charges to load your US stock account. So totally worth it. Now it is time for giveaway. If you sign up on IND Money from the description link and fund your US stock account, you will get free stock of Google worth ₹750 in your reward section. So share this link with your friends and family so that even they get this free gift. Right now, major US stocks are available at a good discount. So do not miss this opportunity on investing in companies like Amazon, Apple, Facebook and Google. Now third stock in my list is from RTA industry. It is CAMS. CAMS recently had its IPO in September 20 and the share price jumped almost 200% from levels of 1300 to 4000 in no time. But since then, the price has corrected significantly and fell down almost 48% to current levels of 2100. If you look at the financials, in last 5 years, its revenues have grown from 659 crore in FY18 to 910 crore by FY22 at a CAGR of 6.6%. Whereas its profits have grown from 146 crore in FY17 to 287 crore by FY22 at a CAGR of 14.5%. Company is highly profitable with 3-year average ROE of 45.3% and 3-year average ROCE of 59.3%. Company has a debt to equity of 0.12, which is negligible. At its peak, CAMS was commanding a P ratio in the range of 70 to 75, which was very expensive. And since then, it has corrected to current levels of 36. Now at current PE of 36, CAMS is looking very attractive. It is because CAMS is the leader in RTA segment and manages almost 67% of AUM of mutual fund industry in India. And mutual fund industry in India is still in its nascent stage. So there's a long way to go for mutual industry in India. And the fact that CAMS is just a 10,000 crore company. So again, a small cap company. Hence, I expect CAMS to grow big in the future and rewards its shareholder handsomely. Especially after almost 48% correction, CAMS is looking very attractive. Next two companies in my list are from telecom technology space. It is Route Mobile and Tanla Platform. Both stocks have grown quickly post-COVID and have corrected significantly from their peak. Route Mobile is down 47% from its peak and Tanla Platform has corrected around 37% from its peak. If you look at the financials, in last 5 years, Route Mobile revenues have grown from 458 crore in FY17 to 2022 crore by FY22 at a CAGR of 34.6%. Whereas its profits have grown from 61 crore in FY17 to 166 crore by FY22 at a CAGR of 22.2%. Company is decently profitable with 3-year average ROE of 19.8% and 3-year average ROCE of 22.9%. It has debt to equity of 0.1, which is negligible. Now, if you look at the financials of Tanla Platform, in last 5 years, its revenues have grown from 579 crore in FY17 to 3,206 crore by FY22 at an exceptional CAGR of 40.8%. Whereas its profits have grown from 41 crore in FY17 to 539 crore by FY22 at a brilliant CAGR of 67.4%. Company is highly profitable with 3-year average ROE of 27.7% and 3-year average ROCE of 33.7%. It has debt to equity of 0.4, which is again very low. Now, as far as future is concerned, both companies are in the business of cloud communication that enables enterprises, OTT players and mobile operators communicate with their customer on the phone via SMS or messages over app. Again, as the usage of mobile would continue to increase, all enterprises would need CPaaS services of Route Mobile and Tanla Platform to communicate with their customer. So the future growth prospects are very bright. Both Route Mobile and Tanla Platform are small cap companies where Route Mobile has a market cap of somewhere around 8,000 crore and Tanla Platform has a market cap of around 18,000 crore. So in this video, we discussed 5 tech stocks that are looking very attractive after the huge correction in the range of 40 to 50%. The list include Affle India, CDSL, CAMS, Route Mobile and Tanla Platform. Now I'm sure that a correction of 40 to 50% creates panic and you start doubting your investment. And if you are confused, then just ask one question. Is there any fundamental problem with these tech stocks? The answer is no. They are highly profitable companies, have negligible debt levels, good amount of free cash flow, and both revenue and profit growths are growing at a very good rate. It is just that 2021 bull market made these stocks expensive, but now there is significant correction and these tech stocks are available at very good valuation. As far as future is concerned, each of the tech stock we discussed have a very bright growth prospect and they are all small cap companies. So they have the potential to grow and become mid cap and eventually large cap in the future. Hence, I believe that this correction has created a great opportunity to accumulate quality tech stocks at good valuation. What is your take on this list? Let me know in the comments. And for investing in the US stocks, do sign up on the IND Money app using the link in the description. This app is absolutely safe and more than 4 million Indians use it. And remember to fund your US stock account to get rupees 750 Google stocks. I hope you find this analysis useful. I'll see you in next video. Till then, take care.